Hey guys, welcome back to the channel. Today we are talking about the best investment strategies for full-time travel and early retirement.
We get a lot of questions on investing for retirement, and especially with the special needs you have if you're doing some full-time travel. So we're going to discuss all of that today. We're also going to discuss how we moved all of our money after the sale of our house into the stock market. Got a lot of questions on that. But the first thing you need to do is to decide what type of investor you're going to be in your full-time travel retirement. And there's really two types of people here. There's people who are living off the dividends of their investments. In other words, if you buy stock in a company, that company takes part of its profits and pays it back to the investors. This can be anywhere from 1 to 5, 6%. And then a lot of people take that money and they just live off of it. So if you have $1 million invested in the market and you're getting 5% dividends, you'll be getting $50,000 a year, which is $4,000 a month. They just live off of that, and that's fine. Other people, though, are not living at all off of their investments. They're just taking those dividends, putting them back into the market, and living off of other income that they have. So those are the two types. You got to kind of figure out which one you are, right?
Mm-hmm. Yeah, and we are the second one. We are growing our investments and not living off of them and making our money elsewhere. So right now we're spending all of that, the dividends, putting them right back in, as well as putting in money as well.
Correct, yeah. So if you're living off the dividends, you definitely want to approach the market differently than if you're not. So if you're living off of them, you need that income. So you have to pay your bills and stuff with that income. So you want safe, high yield investments such as companies like Realty Income, ticker symbol O, or Verizon, or other REITs, which are real estate investment trusts that generally pay out pretty high yields and are pretty safe. Now the good news is this is a pretty good time to buy those because they've been kind of beaten down over the last year. But you want to look for companies that have a track record of paying a consistent dividend and not only paying it, but increasing that dividend. And that's where companies like Realty Income come in, because they are one of the most consistent dividend paying companies in the world. They have paid dividends for an incredible amount of time in a row now.
Yes, 642 consecutive monthly dividends. That's a lot.
That's a lot, yeah.
And they've even gone so far as to trademark the phrase of the monthly dividend company, which that's a pretty big commitment. If you went so far as to trademark that saying for your company, you're committed to making those monthly events, those monthly dividend payments. And we, it's a company that we talk about a lot, all the time. And just as a quick little aside here, we are obviously not experts. This is just our personal opinion and what we do. Obviously, you do your research when you're doing your investments, but we're sharing what we do with our money.
Yeah, we're not financial advisors, but we have been investing for a very long time, and this has definitely worked for us. So Realty Income is one that most retirees have in their portfolio, just because of the fact that it is the monthly dividend company. They're not going to go away from that, and that's what you're looking for. You're not looking for a company that's like, oh, we're going to start paying a dividend, and then 3 months later, we're not going to pay that dividend anymore. Money got tight. These companies are committed. Look for signs of how long have they been paying the dividend, how often do they raise it, things like that. Now, if you are doing what we're doing, which is we're living off of other money that we have coming in, because we have a lot of residual income that we make through our previous careers and through YouTube and through just all different things we've been doing, we're just taking our investments and letting them grow. And when they pay us those dividends, we don't spend it, we just reinvest those dividends back into the market. If that's the case, you want to buy stocks that are going to grow more over the next 5 to 10 years. Because while Realty Income is great for that dividend income, the price of the stock is not going to go up as much as some other companies. And I'm going to give you a couple examples here. like Visa, Elevance, which is an insurance company. That's, think of Blue Cross Blue Shield, and company like McDonald's even. So these companies have a lot lower dividend today. So let's look at some of these. A company like McDonald's has a dividend of 2.25%. Visa is only 0.8%. Elevance is 1.24%. And Realty Income is 5.26%. The difference, though, is if time is on your side and you have time to do this, these other companies like Elevance, Visa, McDonald's, they're raising their dividend at a much higher rate than a company like Realty Income. So look at the difference where the dividend is expected to be after the next 5 years and after the next 12 years. You'll see that the lower income paying companies like McDonald's, Visa, Elevance have all but caught up to Realty Income in what your dividend will be. And in the meantime, in that 12 years that you've invested, they've likely made you a lot more money in the market just because they are growth companies instead of a slow growing company like Realty Income.
Yeah, and I think that's the key there is if you have a time on your side and you don't have to live off of it and you're able to put it right back into the market. If you can get to the point where you don't have to live off of it, that's going to be your very best bet, and that's where you're going to do better and be able to grow your nest egg a lot faster, really.
It is, yeah, and that's why we've done a few extra things. We were in that situation. We just wanted to keep investing. We could stop doing what we're doing and just live off of some of that investment money, but we just said we want to just keep investing that for the next few years and see how much we can grow that. So you want to do that as long as possible if you can, but there will come a time for everybody where we just say, we're done completely. We're just going to live off the dividends for the rest of our life. And that's a good phase to get to also. Next question that comes up is, should you be buying bonds or just stocks? And the conventional wisdom out there, if you Google it, you can Google this right now and say, how many bonds should I buy? The conventional wisdom is that whatever your age is, if you're 50, you should have 50% bonds, 50% stocks. If you're 70, you should have 70% bonds, 30% stocks. And we just don't agree with that at all, because bonds are basically going to get you 5% a year, whereas stocks are going to get you 10%. So people are really only buying bonds out of fear and out of safety's sake. And so if you look at the situation you're in and you say, now the market could collapse at any moment, it could collapse as much as 40%, even 50%. But if that and it has as recently as 2020, it did it in 2008, did it in the early 2000s, did it in 2020. So 3 times in the last 20 years it's happened. It could and probably will happen again. But the thing that happened is when it collapsed, it recovered within a year or two each time. And especially in 2020, it recovered in the same year, higher than it was before the collapse. So if you look at your finances and you say a market collapse of 40% for a year or two would not wipe me out, then there's no real reason to try to be super safe, because you're just leaving money on the table.
Exactly. I think that's the big thing is that safety, zone for people. They just kind of, especially if they're starting to invest a little bit later in life, I think people start to get concerned with that safety issue and, oh, what if it goes down? But like you said, every single time it goes down, it comes back. And even that last time, in 2020, where it looked pretty hairy, it came back the exact same year, which was really kind of mind-boggling how high it came back. So there's really no precedent for that level of fear or to protect yourself at that level with the bonds.
Exactly. So now we're going to get to how to move large amounts of money into the market. And this happens when you sell your house like we did. You end up looking at your bank account, you have a large amount of money in there, and you're like, I got to get this out of my bank account and into the market. But how do I do that? Because it's very stressful, and it is stressful. So we're going to talk about how we did it. The best way to do that is sort of slowly over time, dollar cost average in. So if you have $100,000, you may want to do $10,000 a month for the next 10 months. That would get it all in. Now, the numbers say your best option is to do it as soon as possible. Statistically speaking, the very first day you get that money, if you put it all in the market, most people would come out ahead, because over time, over that year time of putting it in, the market is likely to go up by 10%. So you would be earning 10% on all that money. The problem with that is that there's a 30% chance the market will go down, and that's where the fear comes in, and you don't want to put it on all at once, because what if the market does go down? So there's a little bit of a safety thing there. And then there's like a 5% chance or a 2% chance that the market's going to go really down. So there's probably someone out there that sold their house February of 2020, put $1 million into the market, and then 2 weeks later had lost 50% of their money. And that's the fear, right? So that's why you don't put it all in right away, because you don't really care about statistics. You care what's going to happen to you, and you do not want that to happen. Now, as we said, if those people didn't panic, within a year, they were right back and higher than they were. So it wouldn't have been a big deal anyway. But I think for most people's peace of mind, they want to put it in a little bit more slowly and find some good deals and values along the way. What we did was we put an initial amount in, like 30-40%, and then every time the market took a reasonable dip, we put in another 10%, and we did that for about a year and a half. And culminating, I remember it was Christmas Eve of 2018, and we wanted to get some Apple stock, and for some reason the Apple stock really just took a dive that day, and it was the last money that we had, and I've been waiting for 18 months to buy like Apple stock. And it finally went down. I put the last money in. I was like, we did it. We moved all the money in. It took 18 months.
I do remember that.
Yeah, it took 18 months. You do kind of want to gauge, though, where the market's at. So, like right now, we're at an all-time high for the market. So it's probably a bad time just to like put your whole million or whole 500,000 or 100,000 in, because that's a little risky, right? When you're at an all-time high.
Absolutely. Putting it in when it's high is just, it's going to feel like you're losing right out of the gate.
Yeah, because it's likely.
Because everything's going to be more expensive right then. It is.
So if you gauge the market and you sell your house, and then you see that the market has just either crashed or done a 10 or 15% pullback, that's a good time. Just put it in. You got lucky. Look, you won. You won the lottery of market timing. Like if you had sold your house just after the 2020 crash, just put the whole amount in, because that's a once in a lifetime opportunity.
It is. You're so lucky if that happens. It's rare that will happen right when you've got a big pile of cash sitting ready to go in, which is why it's better to have a plan of what to do, because it will likely not be the case.
Yeah.
But hey, yay for you if it happens.
It didn't happen for us. But
it didn't happen for us.
We took 18 months basically to get it all in there. Again, like 30-40% up front, and then another 10%, 5% really a month. Some months we didn't put any in if there was nothing good to buy. So another thing I'll recommend is if you're moving over $100,000 into the market and want to buy individual stocks, get a service like the one we use, like FastGraphs, which will show you visually when it's a good time to buy stocks based on their historical averages. This isn't a promotion for them or anything. We just use the product, and it's really made us a lot of money over the years. So that's a great place to go. We'll put a link to that in the description. We have a subscription to that. It's like $20 a month. So it doesn't really make sense if you're putting $50 or $100 a month into the market. But if you're moving hundreds of thousands of dollars from the sale of your house, get some reassurance that you're buying stocks at a good time.
Yeah, you want to be able to know that you're making an investment with good knowledge, and FastGraphs definitely is a really good service. Again, we don't get anything out of sharing that. That's just a service that we use. We'll tell you what it is because it's such a good service. We've used it for a while, and it really is incredibly helpful to be able to look at those numbers instead of having to go look everything up, and you're not going to get everything that you want to know. This service will literally deliver it all to your fingertips in a matter of moments.
Right. And then next is where to invest. So when you're investing for the future, you want to make sure you're safe and that your money is safe. So the big thing, there's two criteria for where you're going to invest. First is, are they SIPC insured, which is like the FDIC for the banks, and almost all brokers are. But if they're not, you definitely don't want to invest with them because your money is then not insured, and if they go out of business or they fail, your money is gone. So always just check to make sure that your broker is SIPC insured. And then the second criteria is, how easy is it to use? Because if it's not easy to use, you're not going to use it, and you're not going to be able to just jump in. Like a lot of times we'll see, oh, the market's really taken a dip here the last couple of days. Let's go move $10,000 in. If you have a hard time buying stocks, sometimes you're just not going to be able to do it quickly and efficiently, and you'll miss that moment. So for that reason, we have two places we invest. The first is our broker that we had when we had our bank many years ago, and they're SIPC insured, but it's very hard to move money in with them because it's just a convoluted system they've got.
It's a really old system.
And they haven't changed it.
It's almost like you have to send in a fax or something. It's like that old, archaic feeling. It's just really hard to do, and I actually don't do it because it is so, cumbersome
Bad.
to do that.
Yeah, and then so we have started in the last 3 years, we've been investing with Webull, which is our app way that we do it. They have an app, and you just invest right in your app. You link your bank account to it, transfer your money over, and then you can buy stocks in seconds on there, and it's just amazing. So we'll put a link to that. We won't put a link to our bank broker because don't sign up with them because you're not going to be happy. Maybe your bank broker will be better.
Maybe yours is better.
But our bank sent us an email a couple of weeks ago, and they were like, "We've heard you. We're coming out with a new app." I'm like, "Okay, well, this has been 5 years now." So, we use Webull. If you're just getting started, that's a great place to go and learn, because there's so much information right there at your fingertips. And even when I buy on our brokerage site, I figure out what I'm going to buy in Webull, and then I go buy it on the brokerage site, because you just can't figure anything out on the brokerage app. It's that bad.
Exactly. I mean, that's one of the reasons why I like Webull, is because I can actually do it myself on there. With the bank brokerage is just such a hassle that I just never bothered to figure out how to do it. But on Webull, super easy app right there on my phone. And like you said, it gives you all the information there that you need to make your decision. Like, oh, should I get this or this? Make your comparison, and then easy, couple clicks and you're done. You've purchased it. So I love using it personally myself.
Yeah. So we'll leave links for all those things in the description if you're getting started. If you have questions, let us know. Happy to talk about it, or we can address some stocks that you have questions on one of our live streams that we do on Sunday afternoons U.S. time, usually 12:30 p.m. U.S. time. We will address Eastern time. So hope this has been helpful for you for your investing. This is what's worked for us very well over the last few years, and we've been pretty happy with it.
Yeah, so leave us those questions down in the comments. Guys, don't forget to subscribe to the channel, and we'll see you guys next time.